Hey, welcome back. It's great to have you. We have a wonderful podcast for you today with a really good longtime friend of mine, Mark Rowe. So we're going to talk a little bit about that. I do want to mention that we have a private credit / ABF event coming up in November in my hometown of Austin, Texas. That's going to be November 5th and 6th. It's open to insurance investment allocators that are focused in those areas. You can find it on our website under our events tab, and certainly look forward to seeing you there. It was a great event last year, and it is going to be a good one this year. We're going to have a nice LP to GP ratio, and you're going to be able to see your friends and learn from them and meet some leading asset managers as well. So the title of today's podcast is Lessons Learned from a Reformed Insurance CIO, which I love this one, Mark. And Mark Rose is the insurance solution specialist at Rowe Price. You have a deep background in fixed income. You were the chief investment officer at the Argo Group. Mark, welcome to the show. You and I have homes close to each other. We've known each other a long time, and I'm thrilled to have you on.
Thanks, Stewart. I appreciate it.
Yes, sir. Well, here we go.
Good to be here.
Give us a little bit on Rowe and talk to me a little bit about your career, how you got here. Kind of where you grew up and how your career kind of went from you have a degree. I didn't know this, by the way, a degree in mathematics from the United States Military Academy. Well done. I didn't know that. So what can you tell us about your career from kind of the beginnings there, where you are today?
Sure. I grew up in Plano, Texas, outside of Dallas. Back when I was a young child there, it looked very different than it does today. You could walk outside and see fields. But average kid, went to high school, saw West Point as an option and decided I wanted to climb that mountain. So I went there. I majored in mathematics, you're right. I thought I might do engineering, but the first year I noticed that all the seniors who were in engineering courses were staying up all night, 3 or 4 nights a week. And I thought that was a bad idea. So I pivoted to math and was happy with that. You know, from the Army, from West Point, I was in the Army for a few years. I eventually got out, took, honorable discharge like anyone, got out of the Army. And first job out of the Army was with electronic data systems, EDS, as a systems engineer. So that didn't put me in the investment business, but I was close to the consulting business there. And one of my mentors had been in the investment business. So within 4 years, when I found a half-inch ad in the Wall Street Journal, I literally applied, faxed a resume in, and found myself working at a small boutique manager, sell-side manager for an equity research analyst in 1995, to put it exact. And that's how I entered the investment business. And when I walked in my first interview, the guy said, we walk in and out of the building with the value between our shoulders. And if you work for me and I get an offer to a larger firm, you're coming with me. And sure enough, 6 months later, he got an offer to go to Credit Suisse, First Boston at the time. And I hung on to his coattail and I ended up at Credit Suisse, First Boston. From there, I was an equity research analyst. But within about a year, my paths crossed with a guy named Bob Critchef, who's at Shankman Capital today, but he was running high yield research. And Bob needed some support on his desk because they had lost their analyst that covered telecom, and that was my industry. And so through a project that I was doing for them, I ended up with a job in about 2 to 3 weeks as the telecom analyst for high yield. And that's when I really made a step into my investment career as a high yield analyst and loved those years. I spent nearly 4 years at Credit Suisse and then another 4 years at Goldman Sachs. And that's what put me in investments. And eventually, 12 years ago, I was working on the sell side again at Royal Bank of Canada. And I decided with my wife that living in Minnesota was a great thing as our kids went through high school, but that's not where we wanted to stay. So I started looking for a job in Texas, and my resume ended up with the CEO of Argo Group, Mark Watson. And fortunately, he and the leadership there felt like my background was broad enough between equities, high yield. I'd had 5 years at two hedge funds as well, and pretty much have done investments in just about everything you can invest in, from credit derivatives to private equity to distressed debt. You just line it up. And the board felt like they wanted someone with a broad investment background. So they hired me as the CIO. I can tell you that I did not appreciate or know the process of what a CIO should go through every year, but I soon learned, being surrounded by a number of good people. So that's how I got into it.
That's super helpful. It's funny. We used to, back when the earth was cooling, Argo Group was a client of ours. And, it's interesting that this predates you. And I remember when they ran that search. I'm almost certain I remember when you got hired there. And so talk a little bit about, Argo had its issues, not related to the investment side. What led you to go from the CIO suite to Rowe Price? How did you connect? And I think that it's interesting. You're not alone in this move. What was the thinking there, and how did you connect with Rowe?
That's a great question. I was 11 years CIO at Argo and learned a lot, and we can go over that at some point. But what brought me to T Rowe? Ultimately, Argo was sold to Brookfield Asset Management, and it went through some turnover and all kinds of stuff. In fact, I think at year 7 in my 11 years at Argo, I became the longest tenured senior executive left. And yeah, so, and then within a year or two, it was, we're going to sell it, and that took a couple of years, because you don't just sell a company, especially insurance company. You unpack it first, and then you line it up, and then it gets sold. But I took a severance package after the close of Argo to Brookfield, and I stepped back, and I was kind of torn between, do I try to stay in Texas? Do I try to have another, step into another CIO job? And I interviewed on a couple of different places, and everything's a part of where are you located? Who did you work for prior? Who's your mentors? Where are they? That next job is always tricky. But I called a really good friend who runs Aspida's Insurance Solutions, a guy named Raj Krishnan, to chat with him on an opportunity. And he stopped me full circle on the call. And he said, Mark, I really think you ought to talk to Rowe Price. And he said, given your background in so many different assets and so much of the business, and then 11 years in insurance, they are putting together their insurance solutions, or let's just say making it more today's insurance solutions than, if you look 10 years ago, insurance solutions looked a lot different.
Oh,
Today
yeah.
it's migrated. And he said, really good team. Why don't you talk to Ben Riley, who runs the group, and get to know them? And Stewart, the next day I was on a video call with Ben Riley. The next week, I'm on a video call with the head of investment grade fixed income. The week after that, I'm in their office interviewing. And the week after that, I accepted an offer. So within 4 weeks, it went very fast. But now, why did I do that's the real question. I get it. And a couple of reasons. One, if you look at T Rowe, it's one of the storied histories of success in building an investment firm. Started in 1937, is $1.7 trillion today they manage. There's just not a lot of firms you can say we manage nearly $2 trillion. Secondly, if you look at and I knew this from my high yield research days when they were a client, the whole firm was really founded with equity research. So equity analysts found it, but that bled into credit research. And so credit research is really at the heart of how they select securities and select markets and decide to tilt a portfolio, tactically move. Just they're exceptional and deep and broad in their research. And in credit, you know, and basically for most insurance portfolios, you hold a world of credit in your portfolio, and you know that you're trying to avoid the left tail event. I mean, you're
Absolutely.
not going to find the right tail with research in credit unless
Right.
you're running a special opportunities fund or something. But typically, you're just wanting to avoid the left tail. Well, T Rowe's pretty solid at avoiding left tails, and I, sat down with the team, and you look at Silicon Valley Bank; they didn't have any exposure, for example. The solid research that starts with that, then started peeling the onion or whatever you want to call it, peeling the story back about insurance business. And if you look, T Rowe's always had some solid insurance business management. A lot of it was in high yield and emerging markets where they're very exceptional in high yield and bank loans. In EM, they're very, very good. Have some very large industry names who T Rowe runs EM and high yield for. And they've, in the last several years, have been growing this core business. A very, very significant insurance name is a very large customer in the core business. So the company's had a pretty solid start. But when you say 1.7 trillion in asset, you start to realize insurance is very small. And there's a lot of upside when you think of the BlackRocks and the GSAMs and the JP Morgans of the world. So I see a big opportunity to grow with this business with solid people like Ben and the people I met in the portfolio managers in IG, the portfolio managers in high yield, our EM team. It's a great bench. It's a big industry, and they're now, I would say, sharpening the point to address the insurance opportunity. And you could lace in there too Oak Hill Advisors, who they bought a couple of years ago. They've slowly starting to integrate that, and Oak Hill's bringing a piece of that insurance solution when you think about where the industry's gone with custom rated notes and private debt and structured CLOs, private CLOs. Oak Hill's in the thick of that, and it brings that component to an already very solid, what I would argue, public CUSIP team over at the T Rowe side, who they do some private credit, but Oak Hill brings in that whole flavor that we all know kind of got really opened up in the last few years.
Yeah, I mean, we know we've had a long, very good, very long relationship with T Rowe. Ben, we've worked with Ben a long time, and we have a good friend in Bill Bonesack, who's the president of Oak Hill. So
Yes.
I'm 100% with you all the way around there. You mentioned you were a longtime CIO. Now that you're on the other side of the fence, and I mean, when I did that, one of the things that I noticed is that there's a fair amount of difference in, I mean, I think every insurance company has some things in common, but how they view risk, what is defined as risk, their risk capacity, which is different than their risk tolerance, right?
Right.
What lessons did you learn now that you're on the other side of the fence? How do you apply? It is a different role, right? It's hard to get as close to the liabilities, I think, when you're outside the company. But what lessons have you learned, and how do you apply those?
Yeah. So I was a CIO of a property and casualty specialty company for 11 years. And what I walked away appreciating, I would say, is insurance is the one investor that doesn't start with how do we make the most money? They
Right.
start with the line, what can't we do? Let's figure out what we can't do, whether it's regulatory framework or a capital budget, but you're constantly focused on what can't I do? I don't want to do that because of this reason. And then one other I'd add to the regulatory and capital is the culture or appetite of leadership, the board, the CEO. Their culture and their appetite's going to drive a lot of your job. And if they don't have an appetite for that risk, even though you can take it, you're not going to. And so between leadership, regulatory framework, capital budget, you come down to, okay, here's what we're going to do because we figured out what we can't or what we won't do. And then I think I gained in the 11 years a huge appreciation for those three and the process you go about building your portfolio. And you're really just saying, what risk will I strap on here because of those things? In my early days, the leadership wanted more risk. And so my focus was a lot on building a multi asset risk portfolio. And it did well. But the leadership left to me the process, the SAA, a lot of the things they weren't involved in as much in the start because they just wanted to focus on taking more risk from a multi asset. As Argo went through the activist event, and as you pointed out, it wasn't the portfolio. It had nothing to do with investments. An
Right.
activist got in the stock for a list of reasons. You can go read about it on the internet. I'm not going to go through it. But at the end of the day, after an activist goes through your company and flushes 2/3 plus of the board and leadership, you're going to rewrite every process and governance in the company. So we did that on the investment side. And I had a good chairperson on the investment committee, and we rewrote, the IPS governance, everything on how we did everything from selecting a manager to doing an SAA to what is it exactly we want the board to approve and what do we want them to focus on when we're in a meeting and what do we allow senior leadership to do and focus on. And it was a good process, and it came away appreciating more after my 11 years when we did that. A good process allows you to manage that risk even better than just going out and saying, let's go add more risk. And
Yeah.
so that's kind of where I came out from my experience there. Unfortunately, I was surrounded by some good peers. Back then I was talking to guys like Bill Cody and Jack Nelson and John Gauthier and Rip Reeves and Mark Silverstein. A lot of these guys are retired now, but it was a good group, and you could compare notes. And I was blessed to be able to go through those times.
Yeah, it's interesting. We're doing this chartered insurance investment manager designation with our educational partner, the institutes, and we've had Mark Silverstein just did the case study on property and casualty insurance, and John Gauthier is going to be doing the one on reinsurance. So we're trying to get
Awesome.
some of those kind of sort of highlighting, really showcasing the career of some folks who, and I think those folks are very highly regarded, and they also hold you in high regard. The CIO community, which well, it's a very sharp group of investors, and it's nice that you can get in and compare notes. I guess the one question is, if you had the opportunity, would you do anything different with your role as CIO? Was there anything that you look back and you go, hey, I learned here, I learned there, anything like that,
Yeah.
Sean?
Yeah. I would say I would have put more effort in understanding best practice and process between planning and managing investment committee meetings. You have 4 meetings a year. And after the work we did post activist, every meeting I walked into, the committee knew 90+% of what they would digest in the meeting, what the key issues were, and they were on top of it. And we put more, it's not a lot of work, but we just put more attention to making sure material was digestible, the right decisions were made, and the right topics were covered that manages the risk in our portfolio to support the company. So I didn't have that playbook when I started. So the first 3 or 4 years, I thought it was about, I mean, we managed, we ran an SAA, we ran capital models, but it was really how much risk can I add? And now let me go tell the committee about it. And by the end, I would argue our committee decks, our meetings were just flowing well. And because we really thought about how do we get to the critical things and not waste time on things we shouldn't be talking about. And I gained a huge appreciation for that. So that would be one, is just don't underappreciate the process and getting through what you're supposed to get through and avoid wasting time.
Yeah, I mean, I think it's really interesting. I have someone who's been coaching me as well on those kinds of issues. And I mean, when you get right down to it, I mean, you're doing this every day, all day for the whole quarter, and then you've got like not a lot of time to communicate that to the investment committee, and it doesn't take that much to get like kind of a rabbit going through the room. Okay, that's good. You mentioned one thing. Is there anything else?
Well, that was a big thing. I think other things, we ran an internal special sits portfolio for about 5 years at Argo. We made good money, but looking hindsight, I would argue it's very hard to source and run investments directly at an insurance company if you're focused on plugging into the insurance company on what it needs, whether it's book yield or a specific requirement on a state that you have a portfolio in. And so I would say your core competency should be picking the right managers. It should be picking and communicating the right risk between the managers, and then going back to the committee and making sure we understand the risk and where you want to be. And then if I would, if I could do it differently, I would not have run a portfolio where we're sourcing ideas, but I probably would have continued to run. And I had a huge success in doing co-investments and manager generated ideas. Where do we want to add on, whether it was private credit or an equity position by our activist LP, fund that we were in. But I think focus more of your time on picking the right people to talk to on the other end, on that manager. And then if you can even find that subset of best ideas and you want to add on, that's where we made significant money. And it wasn't, if I look back, most of banging our head on the table when we ran the internal book was the names that we sourced directly and didn't have an idea from the manager. And focus on making sure your decisions on managers are right, your decisions on risk are right, your decisions on planning are right. And then, if there's a best idea, great, but don't, stray from your priorities as a insurance portfolio. So for me, that was a lesson learned.
Yeah, you mentioned the term special sits, and just in case somebody doesn't know the jargon, can you unpack that term and tell us what it means?
Yeah, it was largely a portfolio that had
Well, let's start
distressed
with this.
debt
Special sit stands for special situation,
situations. That's right.
right? Yeah,
Right.
and then
Special
yeah,
situations.
there you go.
It was kind of like saying the word hedge fund. It can mean a lot of things, but
Absolutely.
it typically means you have an open slate to pick where you think value has been created because the investors have left. A lot of times it was in high yield credit, but it could be an investment grade credit. It could be in a stock. It could be in private equity. We had a company that was in liquidation that we figured out was trading at 17 cents, and we were confident we'd get 90 cents in recovery. And I think we got a buck 15 actually. And, it was a special situation. But and we did that, and we did it fairly well. We had about a $300 million portfolio, and we were allowed to place risk in different region or different regulatory portfolios within the company. For example, on our Lloyd's portfolio, we were allowed to own equities, but there were certain rules. Well, we put some on the run equity best ideas in there for extra return, and it did well. So it wasn't a bad model. I just would say hindsight, way too much work for little return on sourcing ideas versus I've got all these funds I'm invested in. I'm an LP in all these funds. Let me pick the best ideas. Your investors, especially in fund, LP funds, private equity, private credit, activists, they're going to tell you about the best trades or their best ideas. You're going to talk about it every quarter. Well, that's a great source that overlaps the job you need to do, which is due diligence continually.
Yeah,
So
it's so true.
that's
We've
why.
two more questions for you. I want to make sure we get to them. So, in your view, how have markets evolved relative to insurance investors? And I think that you've seen a pretty strong trend toward private assets. But talk to us a little bit about that, and then I've got one more for you.
Yeah. Well, first, I would say if you look at insurance, there's been a growth in annuities. And I would argue that in P&C and specialty, there's been an increased focus in capital budget over the last few years. Maybe it's because of reserves. Maybe it's because of some people might think, well, it could be climate change with the hurricanes. Could be that, could be the fires we're talking about. But it seems like capital's a bigger deal at PNC, and you've also seen a growth in annuities, which drives me to trends we're seeing because of this. There's been a lot of focus on dragging in lower rated assets or non-rated assets into a rated structure, which gets you into the private credit realm, whether it be a private CLO or taking a portfolio of loans and doing a rated note on top of triple B and an unrated piece. And it's you could argue it's ratings arbitrage, not going to disagree. And I would argue some of these ideas are really strong and good. Borrowing against LP commitments, I struggle on how that's a bad idea, for a fund. So I think largely there's some great ideas. I do think there are some firms going that direction that may be in assets that may not be as good as we thought. We'll find out. Time will tell. But so dragging lower rated, higher yielding assets into a structure is a trend. Another trend I like going on right now is just the resurgence in yields. And that could lower the demand on the private structures with time here. And that is, we're starting to see the IG core portfolio yielding 5% in book yield today. And you and I both know, well, PNC company runs between 2.5 and 3.5 the portfolio to the book value. So if I can do over 5% in my return, even after tax, I'm double digit to my book value. So that trend to me is one that's kind of countering that whole let's go chase private illiquid credit. If we see a movement higher in rates or higher in yields on future opportunities in the public market, it'll be an interesting where everything goes. So I would say those two things. And then, something that's developed over the years is just the growth in core plus portfolios. When I started, it was core fixed income and it was a risk portfolio. But that layer in between the CLOs, the commercial mortgage loans, those structured notes we just discussed, esoteric ABS, that's really started to become super important because of that first comment was on the fact that capital has become more important for PNC. So, and then annuities, it's always been that way, right? So that's what I've seen.
That's super helpful. You, my friend, are going to be at our private credit event that I introduced at the top of the show. If you were, and this is, if you were in an elevator, and you will be in an elevator, by the way, Mark. If you were in an elevator giving a new contact a 30 to 45-second quick pitch on T. Rowe, what would you say?
Yeah. So I would say this. If you look at T. Rowe, we have a one insurance solution. It's a combination of T. Rowe and Oak Hill Advisors. And when I say one insurance solutions, when you think about your core plus, and risk portfolio, you're thinking about IG fixed income. You're thinking about securitized. you're thinking about munis, EM, and then you come into your core plus and you're looking for a little more illiquidity, but higher yields. And that's where we step in with, we have private credit as well as structured credit. We have custom CLOs, we have CLO management. And then you step down into the lower level, which is your risk portfolio. And you say, hey, I'm looking for high yield bank loans or special situations portfolios. And T. Rowe and Oak Hill Advisors have focused on putting this one platform together. And it really does. We have success stories, we have successful clients, and we have successful PMs that I'm happy to connect you with if you find a need in that between core plus, and risk.
We've got a good friend, Mark Mercurio, who went the other way, right? He went asset manager to CIO seat, and you have come the other way. And it's interesting because the skills are definitely applicable. And it's great to have you. It's great to have you on. Nice to see you, first of all. And I just kind of wanted to ask a couple on the way out, which is, one is really, it's a little unfair because you just got to T. Rowe, but you did go through the hiring process. But you've also hired folks on your own teams, and the question goes, like, what characteristics do you think are important if you wanted to have a career in this business, and what characteristics in your perception were important to T. Rowe?
I think one is intellectual curiosity. I mean, truly wanting to understand, how does this work? And why are we not just putting numbers on a paper, but understanding, do they make sense?
Yeah.
In my career, the best people and I've had a number of people work for me, the best people that have worked for me had a personal intellectual curiosity that I didn't have to go and point out a mistake, because they would see it and go, I got to understand why.
Right.
So that would be one. Then honesty is always a critical one. And with T. Rowe, I think they look for those as well. I think T. Rowe is in it for the long game, not the short game. And the culture here, I've been super impressed with. If you walk the halls here, I mean, there are analysts here at T. Rowe who I spoke to on credits in 2010.
Yeah.
Okay, so I mean, they stay here a very, very long time, and there's a huge commitment to building the business, obviously, with insurance companies. But people generally love working here, from what I can tell. I mean, I don't see a lot of turnover at all. And I just think, I would argue they're a long game. They want to do the right thing for the customer. I think you've met Jeff Devac, a guy I work with who's been here a very long time, and he's head down. I mean, he does he does support on some of our largest insurance portfolios, and I'll go over there and he's buried in something, and he isn't going to stop until he has it done and figured out. And it's
Yeah.
that kind of roll your sleeves up. I don't know, maybe it's Maryland or Baltimore, but so far I've been really impressed.
Yeah, that's super cool. Yeah, we've had exposure to a lot of folks at T. Rowe over the years. We've got a very dear friend in Patrick Farnan on the marketing side as well. And I'm kind of with you there. All right, fun one on the way out. So dinner. You've heard this question before. Dinner. Up to 3 guests, 1, 2, or 3, alive or dead. Mark Rose, who's going to dinner with you?
I thought about this because I remember your questions, and you didn't ask about my paper route, so I couldn't talk about it.
You know what? Honest to
um,
Pete, that's one of the most common answers is paper route. I bet you we've
yeah,
gotten that first job more than the one that we've been asking is first concert. So
don't ask concert because I'm just not that type. Dinner.
All
So
right, yeah.
here's the deal. My father passed away the week before Easter.
Oh,
And
wow. This year.
he nearly made it to 89 this year.
Yeah.
It is a great life. If I talk about the man, I'll have you captivated. You're a wonderful man. But if I could have three people, it would be my dad, his dad, and his dad's dad, who I had interaction with all three in my life.
Wow.
And I would love to go to dinner with them, all at kind of the rough age of 50, but with the knowledge of the whole life.
Yeah.
I would love that dinner.
You know what would be
I'll see
cool? I
him
mean,
someday.
if you showed your dad's dad, just handed him your iPhone and just said, "Here, I have a good friend, a good buddy of mine I ride with, and his grandfather turned 102, and he said, 'What's the most amazing thing you've seen in your life?' And he said, 'Let me get back to you.' And he came back to him and he said, 'The fact that you can ask your phone a question and it'll tell you the answer.'" Like, right? So just part of that, I mean, it's amazing that you'd have the lineage of your family, but it would also be astonishing for them to see kind of what the world's like today, right? So,
it'd be nuts.
Be crazy. We've been joined today by Mark Rose, who's the insurance solutions specialist at Rowe Price. Mark, thanks so much for being on. We've really enjoyed it. Got a great education today. So thanks a lot.
Awesome.
If you like our show, please rate us, review us, make some comments on Amazon, Spotify, or our brand new YouTube channel at Insurance AUM Community. If you have ideas for podcasts, please shoot me a note at stewart@insuranceaum.com. We are the home of the world's smartest money. We'll see you next time on the insuranceaum.com podcast.